Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. You know, there's so much going on here in mid-December 2024. My team and I are really digging in on finishing up our outlook for next year. Reminder that we'll publish out, this is the first full week of January. I think the goal is to publish things on January 8th. But even with that, I wanted to sort of think about this episode as a pause to kind of reflect, year-end reflections. Given that it's December, we're staring down the end of 2024 and the start of 2025. So it's sort of a good time to take a step back, take a look at what's going on, almost like set ourselves up a little bit more for the outlook in 2025. So let's jump into it. Bottom line is, I think, to start, when we look at the economy in the U.S., the economy did much, much better this year than was originally forecast. So the consensus view was for a GDP growth rate of 1.3% as we started the year for 2024. And that ended up being 2.7%. Now, long-term trend is 2.1%. So being 2.7 is better than normal year, which is terrific. And as we look into 2025, by the way, we see a consensus forecast right around that trend growth rate of 2.1%, with virtually nobody talking about recession, which in some ways kind of worries me, but we'll get to that more fully in our outlook. As it relates to one of the drivers of the strong economy, it was actually fiscal spending of the government. So the government operated with a $1.8 trillion deficit this year, and that added to the debt, of course, and our debt now is over $36 trillion. That means the cost of debt, especially with interest rates going up, has been climbing. And the cost of debt, the debt service, or what is the interest paid on our debt, represents 35%. So over a third of our discretionary spending is going towards just paying the interest on the debt. So that's obviously something that's going to be in focus. Now, the Fed maintained a restrictive monetary policy through this year, but they did start their rate cuts in September. We've seen 0.75 of a point, a half a point September, another quarter point in November, and markets are pricing in another quarter point next week at their December meeting. With that, though, even though the Fed's cutting the funds rate, market rates move around a little bit. The 10-year Treasury through the year actually rose a little bit. It started the year at 3.88%, and it sits around 4.2, 4.3%. And so that has a sort of an interesting effect on the bond market in the sense that when rates go up a little bit like that, bond prices go down. So you have the interest on bonds plus the price change. All that adds up to this year so far with a Bloomberg U.S. aggregate bond index return of 2.8%. So very modest return, but positive. Now, on the equity side, when we look at 2024, once again, a pretty healthy growth rate on earnings on the S&P 500, expected to be about 9.6% for the full year. And that has contributed to what has been a very positive return environment for stocks. The S&P 500 was up over 29% year to date as of this recording. And the PE ratio, which is sort of a classic measure of valuation, sits at 27% above its 10-year average. So people would talk about the market being richly valued. And when that happens, one of the effects is while we celebrate the good return, the market almost comes across as being a little bit more sensitive to mixed news or negative news. In any event, another then forecast for 2025 is that earnings growth concept being almost 15% next year is what the market is basically analysts, when they do all their work on the individual companies, you add it all up. The consensus aggregate earnings growth rate is expected to be 14.8%, so almost 15%. So with all that, then looking forward, let's talk about the kinds of things that could influence the markets and increase volatility and that sensitivity I alluded to. The first is inflation. So everyone's expecting inflation to cool further towards the Fed's 2% target. But we also know, for example, that the changes in D.C. will likely be a net incrementally positive on the economy and also inflationary, meaning putting a little bit of upward pressure on inflation. So one of the areas where we could see disappointment is either inflation reheating further, and we did have a couple firmer prints this week actually on the CPI and PPI, but we also have to be mindful of what you might think of as monetary policy errors. So if the Fed doesn't quite get it right, inflation takes off, that's not good. If the Fed keeps rates high or increases rates too much to fight inflation or potential inflation, that could slow the economy, point us towards a recession. So anyway, that's one area. So I think Fed policy and inflation is something that could create some worry or disappointment. A second is, of course, the changes in D.C. Roughly 48% of the population is unhappy with the outcome of the election, and so they're already set up to be worried about it. And when we look at what's happening, there's sort of this move, right, on the part of the incoming administration, the Trump administration, to focus on deregulation, to focus on efficiency and cutting costs, focus on, a much more aggressive foreign policy approach. And all of these things, especially if we see lots of friction or gridlock, resistance, frustration, or kind of sometimes we see anger, basically, in the government, that, that kind of thing worries people. And that could ultimately trigger investors to become worried if they see, real dysfunction or worries in that way. In any event, related to all that, the idea of a focus on spending, we know that they're creating a new department, the Department of Government Efficiency, or DOGE, and they'll be looking for ways to cut spending, just making recommendations back to the administration on what they might be able to do. And in some ways, austerity can be positive as an important step towards reining in the deficit and the debt. But we have to, kind of keep an eye on that from a couple perspectives. Too much austerity, and that could really slow the economy and sort of spook markets, but not enough. And we see the debt continue to balloon. That could be troublesome, right? So that's a topic that will certainly be in focus and will be an influence on the markets. Geopolitical risks are ever present. We've got the hot military, the military hotspots all around the world in a way, but especially Middle East, Israel, et cetera. And we know that the incoming administration, with this shift in foreign policy, they're going to come in kind of aggressive, trying to drag people to the table to negotiate peace, at the same time using tariffs super aggressively to negotiate different deals with different countries, et cetera. And so, you add all that up, and then the markets are there. People are watching. There's just been this general increase in animal spirits, meaning people are feeling pretty positive. But if we see cracks in all of those things, if we see cracks in the economy or cracks in earnings, it's almost like there's so much optimism built in that we have to be mindful that any crack or slowdown or whatever could easily trigger market weakness, given especially the elevated levels that we're seeing. So again, we're sort of sizing up our views. We'll publish them in early January, but I just wanted to take the opportunity in this episode to offer some reflections as we do that. And so listen, we'll, I think, have one more episode for 2024. Look forward to delivering that to you next week. Until then, thanks so much for listening, and we'll talk to you then.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.